Welcome to Talk Tickers. We're your go-to for breaking down the latest earnings calls into actionable insights. Today, we are doing a deep dive into the second quarter 2025 earnings call from Verizon, really getting past the headlines to understand what's driving their strategy.
Yeah, this call really, it underscored a disciplined approach, strong financial momentum, and, well, a crystal clear strategic roadmap. What really stood out to me was their focus on leveraging those core network assets, while at the same time really aggressively pursuing future growth drivers.
Okay, so let's kick things off with the top line numbers. They certainly painted a pretty compelling picture. What are the standout figures for Q2 2025?
Well, the wireless service revenue, that hit $20.9 billion. That's a solid 2.2% increase year over year. And what's crucial to grasp here, I think, is that this isn't just growth for growth's sake. It really speaks volumes about their ability to, command pricing power and maintain customer value in what is a really intensely competitive market.
Right. And building on that, how did the adjusted EBITDA perform? That's always a key metric investors watch closely.
Absolutely.
Yeah.
The adjusted EBITDA was actually a record setter, came in at $12.8 billion, up 4.1% year over year.
Right.
And this is their second consecutive quarter exceeding their guided range for the year. That's a strong signal, really, of effective cost management and operational leverage kicking in.
That is significant. Okay, and when we look at the consolidated revenue, $34.5 billion, right?
Yeah.
A solid 5.2% increase year over year. It was notably boosted by, more than 25% increase in wireless equipment revenue?
That's right.
What does that particular jump in equipment sales tell us about their strategy?
Well, that surge suggests a few things. First, it points to a healthy upgrade cycle, which often correlates with customers opting for higher value plans, leveraging new devices. It also indicates strong consumer engagement with our offerings and perhaps successful promotional activity around new hardware. It's definitely a positive sign for the stickiness of their customer base.
And that profitability, that revenue growth seems to be translating directly to cash flow, correct?
Precisely, yeah. They delivered $5.2 billion in free cash flow for the quarter. That brings their year-to-date free cash flow to $8.8 billion.
Yeah.
And that's $300 million higher compared to the first half of 2024. Gives them significant financial flexibility.
Okay, so given those robust results, it's maybe not surprising they updated their full-year guidance. What were the most notable uplifts there? And what's driving that confidence, do you think?
The updated guidance, it really reflects their strong execution. Adjusted EBITDA growth is now projected at 2.5% to 3.5%. Adjusted EPS growth, that's 1% to 3%. And they've raised their free cash flow guidance significantly to $19.5 billion to $20.5 billion.
Whoa.
Yeah, and a substantial portion of that free cash flow bump, they estimated about $1.5 to $2 billion, is actually due to recent tax reform, which provides a welcome tailwind, obviously, but it's also coupled with their disciplined operational execution across the board.
Okay, so we've covered the impressive headline numbers. But you know us, we always want to dig a little deeper. What were the truly pivotal insights and strategic moves management highlighted? Things that go beyond the basic financials.
Yeah, management was very clear. Their strategy is demonstrably working. The core insight seems to be a laser focus on profitable connections and customer-centric innovation, not just chasing sheer subscriber volume, They're optimizing for value.
Okay. Now let's drill into mobility performance. This is where Verizon faced some headwinds, but showed some notable progress. They reported over 300,000 net additions across mobility and broadband platforms. But drilling into postpaid phones specifically, we saw net losses improve significantly, down to 51,000 compared to, 109,000 in the prior year period. What's the underlying story there? Is this turnaround sustainable? And how significant are those strong gross additions in the grand scheme?
That improvement in postpaid phone net losses, yeah, that's a critical shift.
Yeah.
It signals that their initiatives to sort of stem subscriber bleeding are indeed paying off. And it was largely driven by those strong gross adds, which suggests renewed appeal.
Okay.
However, the business segment did see a dip in phone net adds, down to 42,000 from 135,000 last year. Management attributed this primarily to public sector pressures. They expect that to subside later in the year, so it's likely not a fundamental issue with their core business strategy, more of a temporary thing.
Right, got it. On the flip side, core prepaid was a real standout, 50,000 net additions for the quarter. That's a whopping 62,000 improvement year over year. What makes this particular performance so significant, especially with ARPU now above $32?
Well, this marks 4 consecutive quarters of positive core prepaid net adds. That's fantastic consistency. And the ARPU, the average average revenue per user being above $32 is key because it shows they're attracting higher value prepaid customers, not just, low-end users. Management expects prepaid to be a positive contributor to overall wireless service revenue growth in the second half. So it's transforming what was maybe once a more challenging segment into, well, a growth engine.
Interesting. Churn, of course, always a key focus in this competitive market. Consumer postpaid phone churn was consistent with Q1 at 0.90%. What were the lingering effects there from the Q1 pricing actions and, all that competitive promo activity? And how is management actively addressing this?
Yeah, the consistency in churn, it suggests the market remains highly promotional. Very competitive out there. Management did acknowledge that the Q1 pricing actions, while maybe necessary, had some lingering effects. The response is proactive, though. They launched new initiatives on June 24th. They aim to improve the customer experience and hopefully reduce churn. We'll be watching that closely next quarter, obviously.
Right. And on the upgrade front, total wireless postpaid upgrades saw a 14% increase in the first half of the year. That seems like a strong sign. What does that increase, driven by their best value guarantee, suggest about, customer engagement and their ability to retain and grow those existing relationships?
It clearly shows that their best value guarantee program is resonating with customers. It's driving higher engagement. Increased upgrade activity usually translates to customers refreshing their devices, maybe moving to higher tier plans,
right,
which is a positive for ARPU over the long term. They still anticipate mid-single-digit growth in upgrade activity for the full year, so that indicates continued confidence in this strategy.
Okay, shifting gears slightly to broadband. Their dual fixed wireless access, FWA, and fiber strategy continues to drive market share gains. FWA added 278,000 net subscribers, growing the base to over 5.1 million. That seems firmly on track for their 8 to 9 million goal by 2028.
Yeah.
What's making this FWA push so successful?
Well, FWA's success really lies in its ease of deployment and leveraging their existing wireless network. It lets them offer a competitive broadband alternative, especially in areas where traditional fiber isn't available yet. It's just a flexible solution that's clearly meeting consumer demand.
And Fios Internet also added, 32,000 net subs in the quarter?
Correct.
And they're ahead of plan on their fiber build, aiming for 650,000 incremental passings this year. Are they just, building faster, or are there deeper strategic implications to being ahead of schedule on fiber rollout?
Oh, definitely deeper implications. Being ahead of schedule on fiber isn't just like a technical achievement. It directly translates into rapidly expanding network capacity. This positions them for superior performance and, importantly, new revenue opportunities as more homes and businesses demand that high-speed, reliable connectivity. It's really about future-proofing their broadband offering.
Okay. And speaking of network buildouts, their C-band deployment is also ahead of schedule, targeting 80% to 90% of planned sites by year-end. And nearly all sites are now standalone capable. What's the real advantage there? Being ahead of schedule and having sites standalone capable?
Well, the C-band deployment is absolutely foundational for their 5G expansion. Being ahead means they're rapidly expanding that mid-band 5G coverage and capacity, which is crucial for delivering the speed and low latency consumers expect now.
Right.
And standalone capable means the 5G network can operate independently of 4G. That unlocks more advanced 5G features, even better performance. It's a key enabler for future services.
Okay. This disciplined execution also extends to what they're calling a world's first, their MDU, multi-dwelling unit solution. It's moving beyond trials now.
Yeah.
What exactly is this MDU solution, and what's its potential contribution going forward?
So the MDU solution is designed to bring ultra-high-speed fiber directly into apartment buildings, other multi-dwelling units. It's potentially a world's first because of its innovative architecture. It allows for simpler, faster, more cost-effective fiber deployment to these really dense environments.
Oh.
It's still in early stages, though. More scaling expected in the second half of this year, bigger contribution probably in 2026. So it's more of a long-term play for expanding their fiber footprint.
Got it. The private network business is also scaling, highlighted by that landmark deal in the UK, right? At the SAMS Freeport.
Deploying multiple private 5G networks there.
And their AI Connect offerings, the sales funnel nearly doubled to $2 billion since launch. That sounds like a pretty significant leap beyond traditional telecom. How disruptive are these, particularly this AI at the network edge concept? What's driving this surge in demand?
This is really where the future of telecom meets the enterprise, I think. Private networks offer dedicated, secure, high-performance connectivity for specific businesses or campuses. And the AI Connect offerings, yeah, they demonstrate surging demand for that high bandwidth fiber capacity.
Yeah.
Which is crucial as AI shifts to real-time application, right where the data is generated and consumed, what we call the network edge.
Right.
Think about it. Immediate insights, reduced latency. It's a potential game changer for businesses leveraging AI. And Verizon is positioning itself to provide that essential infrastructure.
And they reinforce their network as a key differentiator, citing J.D. Power, Root Metrics awards, best network quality, speed, reliability. Is this just marketing fluff, or does it genuinely reflect a competitive edge that translates to customer value?
Well, these awards are more than just marketing. They provide independent validation of Verizon's network leadership. For customers, it translates directly to a superior user experience, which is a powerful differentiator in what can be a pretty commoditized industry. And for the company, it can help attract and retain those high-value subscribers who prioritize quality and reliability.
Okay, shifting gears again to financial discipline. What's happening on the cost side? The voluntary separation program is complete. They're pursuing opportunities in legacy businesses like copper decommissioning. How significant are these programs for their long-term cost structure?
Oh, these are substantial drivers of operational efficiency. The voluntary separation program, that generated significant savings already. And the ongoing copper decommissioning, while it's an investment up front, it removes legacy costs and allows them to focus on more efficient fiber and wireless infrastructure. Headcount being down 3.7% year over year is another clear indicator of this disciplined approach to cost management. Ultimately contributes to stronger margins.
Makes sense. Their capital allocation framework remains unchanged, they said. Strategic investment, supporting a healthy and growing dividend, and paying down debt. Net unsecured debt at quarter end was $116 billion. That's a $6.9 billion improvement year over year. What flexibility does this continued debt reduction give them, especially with less than $700 million in unsecured debt maturities remaining in 2025?
This debt reduction is a major positive. It doesn't just strengthen their balance sheet, it also provides more flexibility for future capital allocation. With fewer near-term maturities, they have more discretion to continue investing in growth areas, support that dividend, or potentially even consider shareholder returns like buybacks once their leverage targets are met.
Right.
It signals financial health and strategic optionality.
Okay, a huge piece of their future strategy has got to be the Frontier acquisition. They confirmed it's progressing, on track for an early 2026 close, Q1 2026 specifically.
Yeah, got approvals from 8 states, the FCC, DOJ, moving along.
How transformative is this acquisition really? And how does it fit into their broader vision for broadband growth?
The Frontier acquisition is indeed a significant catalyst. It's going to accelerate their fiber expansion significantly. Gives them access to millions more fiber passings, a larger footprint to offer broadband services. This is a clear strategic move to double down on fiber as a foundational asset for long-term growth and convergence. We're expecting a comprehensive update on strategy and capital allocation closer to the closing.
Okay. And finally, management discussed those comprehensive customer experience improvements launched back on June 24th, AI-powered personalized support, 24/7 service, dedicated care employees who follow requests through leveraging their stores. What's the ultimate goal here beyond just, better service?
Well, the ultimate goal has to be enhancing customer loyalty and reducing churn. Make the customer experience as seamless and personalized as possible. In a competitive market like this, customer service can be a key differentiator. Leveraging AI for support, having dedicated agents, it speaks to a proactive approach, preventing issues, resolving them efficiently. That should support customer retention.
Okay, we've unpacked a lot of numbers, strategic moves. For our experienced investors listening in, what's the overarching narrative here? What are the key takeaways you'd want them to remember from this call?
The overarching narrative is pretty clear, I think. Verizon is executing a disciplined strategy focused on profitable growth, not just chasing volume. Their emphasis on attracting high-quality customers and maintaining financial discipline in this fiercely competitive wireless market, well, it seems to be paying off.
Yeah.
The record EBITDA, driven by strong wireless service revenue and those significant cost-saving initiatives, it really underscores their focus on margin expansion.
And the emphasis on fiber and fixed wireless access, especially with Frontier coming into play, that really signals a robust long-term broadband strategy, right? Leveraging existing assets for new revenue convergence opportunities.
Exactly. This isn't just about mobile anymore. Their commitment to fiber and FWA amplified by the Frontier deal, positions them for significant long-term growth in the broadband market, creates a powerful ecosystem for their customers.
And they're positioning for AI at the network edge. With their existing infrastructure, these new AI Connect offerings, could that unlock significant enterprise opportunities? Is this a differentiator that truly sets them apart from peers?
It absolutely could be. As AI transitions to widespread real-time application, the demand for high bandwidth, low latency connectivity right at the edge, that's going to explode. Verizon's existing infrastructure and proactive AI offerings give them potentially a unique advantage to capitalize on this massive enterprise opportunity. Could unlock entirely new revenue streams down the road.
And that tax reform benefit, that's a notable tailwind too. Gives them additional flexibility for capital allocation, maybe accelerating debt pay down, maybe even share buybacks once leverage targets are hit. Seems like they have more levers to pull now.
They certainly do. Yeah, it adds another layer of financial strength and strategic optionality. What's intriguing here, really, is the company's commitment to building on its network leadership across all fronts, mobile, fiber, FWA, and then strategically monetizing that leadership through segmented offerings and these innovative new enterprise solutions.
All right, time for a bit of fun. This is where we put on our hedge fund analyst hats. Let's be crystal clear. This is not financial advice. We're just having some fun here. But based purely on the data we've just explored, what's an outrageous yet plausible trade idea you could pitch?
Okay, so if we were bold enough, right, pushing the envelope on this data, imagine pitching this to an investment committee. Oh, long Verizon, short legacy infrastructure, pair trade. Sounds a bit out there, maybe.
Yeah,
But the underlying logic is surprisingly compelling, I think.
Yeah.
Go long Verizon with high conviction, based on their accelerating fiber expansion through Frontier and their unique positioning for AI at the network edge, which they explicitly stated in the call.
Okay.
Simultaneously, initiate a short position on a competitor, a telecom pure play that has significantly higher exposure to legacy copper infrastructure, or maybe one that's shown less aggressive investment in next-gen fiber and AI-enabled enterprise solutions. The thesis is Verizon's disciplined capital allocation towards high-growth, future-proofed assets fiber, FWA AI services will drive superior long-term EBITDA and free cash flow growth. Meanwhile, a pure-play legacy player faces increasing headwinds, decommissioning costs, slower transition to high-bandwidth services, ultimately leading to significant relative underperformance.
So the bet is on the future versus the past.
Exactly. And the outrageous part is the implicit belief that the market still undervalues the profound long-term impact of AI at the edge and fiber connectivity as a core utility for that evolution. It's a bet that the future gets here faster than the market thinks.
Interesting thought experiment. So to recap, Verizon delivered a strong second quarter. They raised their full year guidance across key financial metrics, driven by robust wireless service revenue, record EBITDA, disciplined cost management. They're clearly looking forward.
Yeah, their strategic focus on network leadership, profitable customer growth, and those future-proofing investments in fiber, FWA, AI-enabled solutions, it positions them resiliently, I think, in a competitive landscape. They have a clear eye on where the industry is heading.
Well, we've unpacked the numbers, the strategic narrative, and as always, this deep dive is for informational purposes only. It is definitely not financial advice.
Absolutely. And what stands out to you from this earnings call? We encourage you to continue your own exploration of these trends and their potential impact on the broader market.
That's it for this edition of Talk Tickers. Join us next time for another deep dive into the numbers.